Okay, let's talk about gross income from personal and investment activities. Okay, here is our lecture overview. The first thing we want to discuss is the modified adjusted gross income. Magi, however you want to say it. Not these magi, but what this stands for is modified adjusted gross income. And as you read the book and as you work in tax, you're going to see this term a lot. And for our purposes, don't worry about the difference between the modified adjusted gross income and the unmodified, the AGI. So for each use of modified adjusted gross income in tax, there are different modifications. And again, for our purposes, you don't need to worry. In the real world, most of the time, there are no modifications to get from AGI to MAGI. So there you go. You'll see that term a lot. There are different categories of income, and we're going to start out this course dividing income into investment, personal, and employment income. This is the type of activity that earned the income. On the other hand, there are different ways to categorize income. And so often you'll see income categorized by ordinary versus capital gain income. Ordinary income means that it's income that's taxed using the tax rate schedules that we discussed in Chapter 3. Capital gain income means that it's taxed using the long-term capital gains rates, which we will talk about here in a moment. But ordinary income, for example, is not exclusive from investment income. And for an example, here's an example with the Jones family. They had the following income: $100,000 from salary, $5,000 from interest, $700 from prize winnings from a drawing at a grocery store. Good for them. And $3,000 of long-term capital gains from the sales of stock. So you see here, this first way we can break down their $108,700 income is by investment, personal, and employment income. But we could break down their income in a different way, ordinary and capital gain income, as you can see. So just be really comfortable with these terms when you see them. Okay, so we're talking about personal investment income in this chapter, and that means gross income. So gross income is the income that you are actually going to report as income on your Form 1040. Let's talk first about what we mean by capital gains, capital gain income. So in this example, Carl bought 100 shares of Clorox on April 1st of year 1 at $50 a share for a total of $5,000. On May 2nd of year 1, Clorox is worth $60 a share, or it's worth $6,000. And on June 3rd of X3, year 3, Carl sells the stock at $70 a share for a total of $7,000. So the question to you is, how much is taxed and when? So the answer is that Carl is going to be taxed on $2,000 in year 3. And what that $2,000 represents is the gain. He paid $5,000, he sold it for $7,000. So, number one, there is no taxation on stock or any other capital asset until it is sold. At that point, what we say the gain is realized, so be comfortable with this vocabulary word. And number 3, Carl must include the gain on his year 3 tax return. We say that the gain is recognized, which just simply means that it is included on his tax return. So this is some important vocabulary. Now, we are using cash basis accounting here. And so number 4, only the gain is taxed, not the total proceeds. So proceeds are what he sold it for. His basis is what he paid for it, and so the gain is $2,000. So let's talk about basis just a little bit more. It is what Carl paid for it, but notice in this box there's a little more detail. The basis is the amount paid for the stock with after-tax dollars. So proceeds, gains, gain and basis. So what do we mean by after-tax dollars? The basis is the amount paid for the stock when paid for with after-tax dollars. Carl does not pay tax on his basis because it's already been taxed. And this is the concept of basis recovery in tax, is taxpayers can recover or get their basis back tax-free because they've already paid taxes on that money once. Now, what do we mean by after-tax dollars? That he's already paid for it with after-tax dollars. So in this example that we're making up here, uh, in this case, the $5,000 that Carl used to buy the stock was money that he had earned as wages 5 years before. So 5 years ago, the wages were included in gross income that year. He paid his taxes like he should. He put the money in a savings account. And so this is what we mean. It was paid for with dollars that already had been taxed and included on a tax return. So that's why he has basis. Capital gains rates. So we've already looked at tax rates. These were the ordinary rates that we looked at in a prior chapter. But there are also long-term capital gains rates. These are the ones for 2019. Notice that this is long-term capital gains. Now we're going to have a whole chapter on what capital assets are. So for our purposes right now, let's just think of capital gains as increases in stocks. When you sell them, you have this capital gain. So notice here that we've got different tax brackets, but they are only 0, 15%, and 20%, not the other many tax brackets that we have for ordinary income. Notice also that these tax brackets differ by your filing status. Okay, notice also that these tax brackets are very, very broad. So for example, the single filer tax brackets at 15% goes from a taxable income of $39,375 all the way up to $434,550. And these numbers here, the income in the table is taxable income, not adjusted gross income, not gross income. This is taxable income. Now, we said that this was long-term capital gains. And what do we mean by long-term? That means that the stock is held over a year. In other words, a year and a day. Another thing to notice about these tables is that the highest tax bracket for capital gains is 20%. Now, often, on TV, all these little tax blurbs you hear, they refer to the capital gains rate of 20%. But how many people really pay 20% on their capital gains? Almost nobody, because your taxable income has to be so high before you even get up to that 20% rate on taxable on capital gains, long-term capital gains. Here's our example. Sherry's single. She bought the stock on January 2nd of year one. She has taxable income annually of $300,000. Now this puts her in the 35% ordinary tax bracket, but she's planning on selling on January 2nd of year two, and she wants to know the tax consequences. All right, she's going to sell her stock. So what are you going to tell her are the tax consequences? Well, actually, if she sells on January the 2nd of X2, the gain will be short-term gain, and these long-term rates will not apply. So the gain will be taxed at her ordinary rate of 35%. So how did we define long-term? A year and a day. So she needs to wait until January 3rd of year two in order to sell. And in that case, the gain will be taxed at only 15%. How do we know that? Look in the single filer tax bracket. Look down there and you see that her taxable income falls within that 15% tax range. So this is a difference of that capital gain being taxed at 37% because it's short term, or being taxed at 15% because it's long term. So, of course, an income tax planning principle is take advantage of long-term capital gains rates. So, really work at holding appreciating capital gain property for over a year, unless there's some really good reason. Okay, Roberta bought 100 shares of Apple Inc. on April 1 of X1 at $300 a share. She sold the shares on April 18th of X2 at $400 a share. So she is married filing joint with taxable income, which includes her gains, because this is taxable income, of $75,000. Now, at what rate will the gain be taxed? Okay, so we look at married filing joint, taxable income $75,000. Whoa, look at that tax rate. 0%. She's going to pay no tax on these long-term capital gains. Now, if she so this would be a good strategy for her to sell it and pay no tax on the gain. Now, if she still actually in reality wants to hold this stock, if desired, she could sell it and then repurchase the stock and have a higher basis so that in the future, when she is above that 0% capital gains rate, she would have a higher basis and have less capital gain at the time she sells it again. So, tax planning principle. Take advantage of long-term capital gains rates. If you have clients with fairly low income who will soon have higher income, sell stock at a gain and repurchase it to avoid capital gains taxes in the future and get a higher basis. So, be aware though, we do have this kiddie tax for taxpayers 23 and younger. Okay, let's just mention qualified dividend income, another type of investment income. This is reported both to the taxpayer and to the IRS on this Form 1099 dividends. Notice that there are boxes for both ordinary and qualified dividends. Now, in this example, the total ordinary dividends are $100. 75% of those are qualified dividends. This taxpayer does not have a total of $175 of dividend income, only a total of $100, 75 of which are qualified dividends. So, what's special about qualified dividends is that they are taxed at the long-term capital gains rates. So when you were looking for investments with dividend income, be aware of whether those dividends that will be received will be qualified dividends, because it'll be the difference between whether they're taxed at capital gains rates or ordinary income tax rates. Let's talk a moment about annuities. What is an annuity? It's a steady stream of income that's going to start at some point in the future. So annuities are a type of retirement account. Now these aren't are not usually offered through the employer, but they are a type of retirement account. Okay, let's go through and look at Thomas's situation. Now, Thomas bought an annuity contract from an insurance company for $100,000. So when we say that he bought an annuity contract, he just made a contract with the insurance company that he would give them $100,000. They would invest the money, and at some point in the future, Thomas will get a steady stream of income for some period of time. So this $100,000 is his investment in the contract, or his basis. So this again is money that in the past he included on his income tax return. He paid income tax on it, and so he used it to buy this, and so he has basis in it. Now, the investment bought him the right to receive a regular stream of income at some point in the future. Here's what happened. The insurance company invested Thomas's $100,000 within the annuity account, and the investment grew tax deferred, meaning no one paid income tax on the earnings while it was in the annuity account. So tax deferred, it does not mean that it's tax free. It means that you will pay tax later, not pay tax as the money is as the income grows, as the account grows due to income. You're not going to pay income tax at that time. Pay it later when it's withdrawn. So the insurance company, they did a good job of investing his $100,000. So the balance in the annuity account grew greatly. The insurance company invested in capital gain properties such as stocks, which generated long-term capital gains, which accounted for most of the growth in the annuity. They also, I'm sure, invested some in interest-bearing instruments, but most of this growth in his account came from long-term capital gains. So they invested in ordinary income properties such as bonds, which generated ordinary income in the form of interest. So the account grew due to both ordinary income and capital gain income. After several years, Thomas has now decided he's ready to take this steady stream of money, so he annuitized the annuity contract. So annuitized is another vocabulary word you need to be comfortable with, which just means that he began to take his steady stream of income. So Thomas's annuity will be $1,388.89 per month for 15 years. So this is what the contract specified, which totals $250,000, his expected total return. So 250, he expects to get that much over the next 15 years. Now again, of course, tax deferred does not mean tax free. And so far, Thomas hasn't paid any income tax, but when he starts receiving his annuity, at that time, he will have to pay income taxes. Now we have this concept again of basis recovery, so he will not pay tax on his basis. Over his lifetime, he expects to receive $250,000. The basis of his investment is $100,000, and so he will be taxed on the difference of $150,000 ratably over 15 years. So how much of his annuity, each annuity, will be taxable and how much will be non-taxable return of his basis? In order to calculate this, we have the exclusion ratio, investment in the contract divided by the expected return times the distributions received. So, and the excluded amount, meaning the amount that will not be taxable from each payment he receives, we take the $100,000 divided by the 250 times the amount he will actually receive for each payment, and we come up with the number of $555.56. And so we see that 40% of each payment he receives will be excluded from income tax, which means 60% of each payment he receives will be included in income tax. So over the life of the contract, he will exclude, look there, $100,000 basis. Now, all right, and he will annually include $10,000 in taxable income. Now, he comes to you to ask about the taxation of that $10,000. Well, is the money going to be taxed at long-term capital gains rates? Because most of the growth in that account came from long-term capital gains. Oh, no, this is what hurts. The income is going to be taxed at ordinary rates. Ouch, ouch. That's because when you withdraw money from retirement accounts, such as annuities, it is taxed at ordinary rates. It doesn't matter whether the investment grew because it was invested in the stock market or grew because it earned interest. So withdrawals from most retirement accounts is taxed at ordinary rates, even the portion of the growth due to long-term capital gains. This is true for money in retirement accounts. So as you read about annuities in the book, notice aspects of basis recovery, the ordering of withdrawals, income or basis, and penalties for early withdrawals. So some income tax planning principles is take advantage of long-term capital gains rates. Be sure to assess your client's goals carefully before putting them in an annuity that will generate ordinary income instead of putting some money in a non-retirement account that will generate long-term capital gain. And the second principle here is to avoid additional taxes, interest, and penalty. Be sure to assess your client's cash flow needs carefully before putting them in an annuity that will force them to pay high fees and penalty to get needed money out. I've worked with people who someone sold them an annuity and they didn't they needed the cash and they had to go withdraw it, and the penalties for early withdrawal from annuities are really high, so be sure you avoid that.